what if the direction of one of the world's biggest currency pairs isn't driven by charts or trends or price action at all?
Right.
Like, what if, at the end of the day, it's entirely about one simple, undeniable concept: incentives?
It completely flips the script, you know? I mean, you stop looking at the day-to-day noise on a screen and you start looking at the actual plumbing, the architecture of the global economy.
Yeah, exactly. And welcome to this deep dive, by the way. Today, we are setting our sights on the macroeconomic landscape of the US dollar to Japanese yen exchange rate, the USD JPY.
It's a massive financial engine.
It really is.
Yeah.
And we're specifically looking at where this engine stands heading into the second quarter of 2026.
Right.
And to do this, we're unpacking a ton of institutional FX flow data, central bank models, and macro strategy frameworks, just to really decode what's happening behind the scenes.
Yeah, we are looking at this through what you would call a macro campaign framework.
Okay, a macro campaign framework.
Yeah, it's a way of seeing the market that basically ignores the daily chatter.
Right, which means we should probably set some ground rules for you listening right now.
Yeah.
We're keeping things simple. We're keeping our sentences short. We're keeping it conversational.
Absolutely. No textbook lectures here.
Right. And most importantly, we aren't predicting the future. Trying to guess where a currency will trade next Tuesday is just, well, it's a fool's game.
Oh, completely.
We're doing something much more reliable. Okay. We're just following where the money's being rewarded to go.
That is the ultimate goal. Identifying the structural forces that, push capital from point A to point B over months, even years.
Okay, so let's unpack this. If we're talking about incentives, we really have to talk about the absolute biggest incentive in all of global finance, which is yield.
Yield is gravity. I mean, it is the gravitational pull of the financial universe. Money will always eventually flow to where it gets treated best.
Right. And when you look at the USD JPY dynamic heading into Q2 2026, the contrast is just incredibly stark.
It's night and day.
Yeah. On one side, you have the Federal Reserve, and even if they are plateauing, they're maintaining these restrictive high rates. They're keeping a really tight grip on the reins to make sure inflation doesn't just roar right back.
Which means the risk-free rate of return in the U.S. remains, materially higher than almost anywhere else in the developed world.
And then, on the exact opposite side of the spectrum, you have the Bank of Japan, the BOJ.
Right.
While the rest of the world spent the last few years hiking rates aggressively, the BOJ has made what can only be described as, marginal tweaks. Just hesitant little tweaks.
Very hesitant.
We're still talking about a historically loose stance here. Rates in Japan remain near zero in real terms.
Yeah, and that creates a massive, stable, and still very wide carry advantage that sits firmly in favor of the U.S. dollar.
So let's just make sure we clarify that mechanism for a second, just so we're all on the same page.
Yeah.
The carry advantage, or the carry trade, is essentially borrowing the cheap currency, right?
Right, the yen.
The yen, where interest rates are effectively zero. And you use that to buy the high-yielding currency, which is the dollar, where rates are much higher. And you just sit back and pocket the difference.
Precisely. You're getting paid every single day just for holding the position.
Okay, so to put this in perspective for the listener, it's like, imagine you're a consumer, right? And you're choosing between putting your money into a high-yield savings account that pays you 5% or just literally stuffing cash under your mattress.
Exactly.
Why wouldn't the money naturally flow to the high-yield account? Why would anyone choose the mattress?
They wouldn't. I mean, it absolutely has to flow. The mathematical incentive is just too strong. If you are an investor, holding yen right now essentially pays you nothing.
Right.
And it might even lose you money when you factor in inflation, but holding dollars pays you a premium. So the money flows across the Pacific.
But I want to push back on this a little bit, because this is where my mind immediately goes. If the gap is that obvious and the yen is getting hammered by these outflows, why doesn't the Bank of Japan just raise their rates?
Ah, right.
Like, they're a central bank. Can't they just step up to a microphone tomorrow morning, declare a higher rate, and just close the gap?
Well, technically, yes, they have the authority to do that, but practically it would be mathematical devastation.
Devastation.
Complete devastation. This is the whole concept of policy asymmetry. It's not just that the Bank of Japan chooses not to raise rates to match the Fed. It's that they structurally cannot do it.
Wait, but they've been trapped in this low-growth, high-debt cycle for like 2 decades. Everyone knows Japan's debt is astronomical. Why is it suddenly a breaking point now that prevents them from acting?
Because of the specific mechanics of how they've managed that debt over the last decade, they instituted something called yield curve control.
Right, YCC.
Yeah. And to keep interest rates at zero, the central bank had to step in and buy practically every single domestic government bond in sight.
So the central bank is the primary owner of the government's own debt.
By a massive margin. Their balance sheet is just bloated with trillions of yen worth of these low-yielding assets. And furthermore, Japanese commercial banks, regional banks, and pension funds hold the rest of it.
Okay.
Now think about the inverse relationship between bond prices and interest rates.
Right. Rates go up, prices go down.
Exactly. So if the BOJ suddenly hikes interest rates to, say, 3 or 4% to catch up with the U.S., the market value of all those 0% bonds they printed over the last decade absolutely plummets.
Oh, because nobody wants to buy an old bond yielding 0 when new ones are yielding 4%.
Spot on. The value of those old bonds crashes, which means the balance sheets of the Bank of Japan, and more importantly, every single regional bank in Japan, takes a devastating instantaneous hit.
Oh, wow.
Yeah. You run the risk of immediate insolvencies. You trigger a localized financial crisis overnight.
So they are completely boxed in. Any aggressive normalization like hiking rates quickly destabilizes their entire domestic financial system.
That is the structural trap. They also risk choking off the very fragile, weak inflation dynamics they finally started to see after decades of deflation.
Right. They finally get inflation, and a rate hike would kill it.
Exactly. The Fed can afford to stay restrictive, but the BOJ cannot afford to follow them. That asymmetry is the bedrock of this entire macro landscape.
But the real story is how this actually plays out in the real world.
Yes.
Because we've talked about the central banks, right? We talked about the theoretical rates and this policy trap. But let's pivot to the actual money moving across borders.
The physical flow.
Exactly. Who is physically executing this? Who is taking capital out of Japan and putting it into the U.S.?
We're talking about the true heavyweights of the global financial system here. Japanese institutional investors.
Okay.
Massive pension funds, like the government pension investment fund, which is, one of the largest pools of capital on the planet. Add in giant Japanese life insurance companies and enormous asset managers.
So this isn't retail money. This isn't guys trading in their basements. This is the big money.
The biggest. These institutions manage the retirement savings and the wealth of an entire aging nation.
Ah, the demographics.
That demographic reality is crucial here. Japan has an aging population, meaning these pension funds have to pay out more and more to retirees every single year. They have strict actuarial mandates for returns.
Right.
They literally cannot survive. They cannot meet their obligations by keeping their capital at home, earning a fraction of a percent.
So they are forced out on the risk curve. They're geographically forced to go abroad.
It is a demographic and mathematical necessity. They are actively forced to look abroad for returns that simply do not exist in Japan. Global investors, and especially these Japanese institutions, are just consistently drawn toward U.S. dollar assets.
And I imagine it's not just the yield, right? Like, obviously, the yield is the primary magnet. But if I'm a pension fund moving $50 billion, I need to know I can actually get in and out of the market without breaking it.
That is such a critical point. It's the sheer depth and liquidity of U.S. financial markets.
Right.
You can move tens of billions of dollars into U.S. treasuries without causing a ripple. You can easily liquidate those positions if needed. You simply cannot find that scale of liquidity anywhere else in the world.
Let me stop you there, though. Surely it costs money to move those funds around and protect against currency swings. Like, if a Japanese insurer buys U.S. bonds, they are exposed if the dollar suddenly crashes against the yen, right? Don't they pay to hedge that risk?
They often do, yes. Hedging costs are a major factor when you look at institutional flow data. But heading into Q2 2026, the yield gap is so exceptionally wide that it frequently justifies outbound investment on an unhedged basis.
Wait, meaning they just buy the dollars naked? They take the currency risk just because the interest payout is that good?
They just take the risk. The mathematical incentive overcomes the fear of currency fluctuation.
Yeah, I want to play devil's advocate for a second. Because when I think of currency trading, or Forex, the image that comes to mind is this extremely fast-paced environment. I think of guys staring at 6 Bloomberg terminals, shouting. Isn't currency trading just hot money and day traders reacting to the latest geopolitical headline?
That is probably the most common misconception about foreign exchange markets.
Really?
Yeah. It's true that on a minute-to-minute or even day-to-day basis, the noise is driven by algorithms, high-frequency trading, and day traders reacting to headlines. But those short-term participants do not dictate the structural trends of a massive currency pair like USD JPY.
Because they just don't have enough capital to overpower a national pension fund.
Not even close. A massive Japanese pension fund doesn't day trade. When they decide to allocate $50 billion into U.S. assets, they do it over a multi-year horizon. They execute those trades slowly, steadily, over months. That creates a structural, persistent tailwind for the dollar against the yen. The day traders and the algorithms are really just surfing on the massive waves created by these institutions. Now, here's where it gets interesting.
Because nothing moves in a straight line.
Right. Never. And we have to acknowledge the broader environment. We're operating in a mixed regime market right now.
What does that mean?
Well, we bounce back and forth between risk-on periods where equities are flying and everyone feels incredibly optimistic, and then risk-off periods where everyone is suddenly terrified of a recession or a geopolitical shock.
And historically, the yen has this deeply ingrained reputation as a safe haven currency.
It does.
Yeah.
And that adds a crucial layer of nuance and sometimes confusion to this entire macro campaign framework. During sharp risk-off moments, maybe there's a sudden shock to global equity markets or feels that the central bank might secretly intervene, the yen actually strengthens. Capital temporarily rushes back into Japan.
Wait, let's break down the mechanics of why that happens. Because earlier you said holding yen pays you nothing.
Right.
Why would people rush to buy an asset that pays them nothing just because the stock market had a bad day?
It comes back to the carry trade we discussed earlier. Remember, to execute that trade, investors literally borrow yen. They sell that borrowed yen to buy dollars.
So they are heavily short the yen.
They are massively short the yen. Now, imagine a panic hits the global markets. Volatility spikes. Institutional risk managers look at their screens and say, we need to reduce our exposure immediately. To exit the carry trade, you have to sell your US dollars, buy Japanese yen, and pay back the original loan.
Oh, I see. So when panic hits, you have thousands of massive players all trying to buy yen at the exact same moment just to close out their loans.
Exactly. It's a massive short squeeze.
That sudden, violent wave of forced buying is what physically drives the price of the yen up. It's not necessarily that they love Japan's economy, it's that they are forced to buy the currency to cover their positions.
That is the exact mechanism. It's force buying. It creates positioning squeezes.
I love visualizing this stuff. It feels like, okay, think about it like pulling your car over under a bridge during a sudden violent rainstorm.
Oh, I like that.
Right, like it makes complete sense to protect yourself for a minute while the visibility is zero and it's pouring. That's the yen safe haven spike. You park under the bridge. But as soon as the rain stops and the sky clears up, you don't stay under the bridge forever. You get right back on the highway.
That is an excellent way to conceptualize the macro execution strategy in this environment. Unless that storm turns into a completely washed out road, unless it evolves into deep, structural, systemic stress, these yen rallies are temporary.
So how does a smart player actually trade that? If you know the math still favors the dollar getting back on the highway, what do you do when the yen violently spikes?
For position builders who are operating on this macro framework, these yen spikes are not trend reversals. They are strategic pullbacks.
Opportunities.
Exactly. They are opportunities to accumulate dollar exposure at a much better price.
So when everyone else is panic buying yen to cover their shorts, the macro players are patiently buying the dip on the dollar.
Essentially, yes. But it requires immense patience and iron discipline. You don't chase the market. You scale into the position slowly during those fearful moments.
Right.
The entire strategy is anchored in a firm conviction that the overarching macro drivers, the wide interest rate gap, and the relentless institutional capital outflows from Japan are still intact. You are trusting the underlying plumbing over the temporary panic.
Let's zoom out for a second, because as much as we were talking about how strong this setup is and how massive these institutional flows are, no campaign is bulletproof. Market dynamics change.
They absolutely do. You always need to know where the exit door is.
So what breaks the machine? If I'm listening to this and I want to know when this entire thesis falls apart, let's walk through the invalidation triggers.
Okay.
And if this entire structure is built on the interest rate gap, the most obvious threat has to come from the central banks themselves.
All right. That is where you look first. The primary invalidation trigger would be the Bank of Japan somehow finding a way to enter a meaningful, sustained tightening cycle.
which we said earlier they can't really do.
Right. But if they did, and we aren't talking about them tweaking a fraction of a percent, we are talking about a real aggressive series of rate hikes.
Got it. If they somehow figure out a way to diffuse their domestic debt bomb and start offering, say, 4% on their bonds, the money stops leaving Japan instantly.
It would violently reverse the flow.
Okay, what's next?
The second trigger is the mirror image of that, originating in the United States, a rapid shift by the Federal Reserve toward aggressive easing.
So if the U.S. economy suddenly rolls over and the Fed panics, slashing rates back down towards zero?
Exactly. That would compress the carry advantage from the top down. The incentive vanishes.
Okay, so that covers the central banks. But what about the players moving the money? What if those massive Japanese pension funds and insurers we talked about earlier suddenly decide they just don't want to play in the U.S. market anymore? Does a massive repatriation wave kill the trade?
That is the third critical trigger, a structural reversal in capital flows. Imagine a scenario where, perhaps due to a regulatory change in Japan or a massive shift in their domestic tax structure, those institutions are incentivized or forced to bring their trillions of dollars back home.
Which would be huge.
Massive. If that steady outbound flow turns into a massive inbound flood, the foundation of the dollar's strength in this pair completely cracks.
And what about the rainstorm analogy? The temporary panic under the bridge. What if it's not just a passing storm? What if the bridge actually collapses?
Ah, the fourth trigger. A prolonged systemic global risk-off environment.
Like 2008.
Yes. If we enter a massive multi-year global recession or a catastrophic geopolitical conflict that entirely breaks global trade, if the global preference shifts entirely to safety, liquidity, and deleveraging over the pursuit of yield for a sustained period, well, the yen would gain a durable long-term advantage as the carry trades are permanently unwound.
Okay, so we have our radar calibrated. Yeah. We're watching for sustained BOJ tightening, rapid Fed easing, massive institutional repatriation, or a systemic global meltdown.
Right.
So looking at the data and the macro landscape for Q2 2026, are any of those alarm bells actually ringing?
Based on the institutional flow data and the central bank policy notes we're analyzing right now, no.
None of them.
For now, these invalidating conditions simply do not exist. The Federal Reserve remains restrictive and cautious about inflation.
Right.
The Bank of Japan remains completely trapped by its domestic debt architecture. Japanese institutional capital is still steadily flowing outward to meet those demographic obligations. And while we certainly have volatility, we are not in a systemic 2008-style global meltdown.
So the structural incentives are still completely intact.
The core drivers have not altered. The price behavior we see day to day, despite the periodic countermoves and those sudden safe haven short squeezes, continues to broadly align with the core incentive structure.
So let's bring this home for the listener. What does this all actually mean? The takeaway from this deep dive is incredibly clear. As long as that yield gap exists, as long as the U.S. Federal Reserve stays higher for longer, and the Bank of Japan remains tied down by its own localized debt constraints, massive amounts of institutional capital are going to keep flowing toward the U.S. dollar.
The underlying incentive dictates the flow of the capital, always.
And the most important thing to remember is that price is not the driver. The flashing red and green numbers you see on the screen are merely the byproduct of these massive tectonic financial shifts.
Exactly.
Charts don't move the money. Moving averages don't dictate the flow of a $50 billion pension fund.
Yeah.
Incentives move the money, and the charts just record the aftermath.
Which is exactly why understanding the mechanics of how these systems interact is infinitely more powerful than just, reacting to a headline.
Now, before we wrap up, I want to leave you with a thought experiment. Something to mull over that goes beyond just the next quarter or two.
A look over the horizon.
Yeah, exactly. Think about the sheer, almost unfathomable scale of Japanese institutional money that is currently sitting overseas right now. We are talking about trillions upon trillions of dollars chasing yield outside of Japan.
It's staggering.
It is. And we know this entire global macro structure relies heavily on that capital staying abroad. It provides liquidity to U.S. markets. It supports the dollar. It is literally a foundational pillar of the modern financial system.
It is the ultimate carry trade.
So ask yourself this: what kind of shock would it actually take to force a structural repatriation? If the economic ground truly shifted and those Japanese pension funds were forced to bring all that money home, how violent would that unwinding be for global markets? Right. If trillions of dollars suddenly exited the U.S. Treasury market to flood back into Tokyo, what happens to global borrowing costs?
It would be an absolute earthquake. The ripples wouldn't just affect the yen, they would be felt in every single asset class, every equity market, and every bond market on Earth.
It is a staggering thing to picture and a reminder of how interconnected the plumbing of global finance really is. Thank you for joining us for this deep dive. As always, don't just take the daily market chatter at face value. Keep looking under the hood, keep digging into the mechanics, and keep questioning the incentives driving the machine. We'll catch you next time.